So the markets have been red pretty much all month. Inflation is hitting record levels, and my portfolio is down for the first time from week to week. But you know what? I'm not worried. This is all a sale for me, and I'm going to go into a new position that I found that I think is a good way to, use inflation. So with that said, let's start the intro. So in the tax-free savings account I have, our portfolio value is $11,920.91, down $33.09 on the day, or pretty neutral, not much movement here. Past week has been pretty brutal for the portfolio. We're down $332.52 or minus 3%. Again, everything is down this month and so far for 2022. In the past month, we're still up $219.28 or about 2%. In the past 3 months, we're up $78.39 or 1%. And in the past year, we're up $797.11 or 7%. And all time, we're up $802.75. So, it's unfortunate to, of course, lose your, gains, at least on paper. But again, I'm in it for the long term. It's not like I'm selling my portfolio tomorrow. So please subscribe to the channel, leave a like and comment if you enjoy the video, because I'm so close to hitting 300 subscribers. All right, let's get into the portfolio and the positions I updated. So we can see even large companies like Apple are going to be down, Microsoft. We're starting to see pullbacks all across the market. It's not just the highly speculative stocks. It's going to be even your blue chip, large companies that are stable are going to be experiencing some downturns. Algonquin's been pretty steady, but honestly, this stock has been beaten up ever since I've owned it. So it's like market crash. I don't know what that is. I'm just gonna stay down anyway. Alimentation Couche-Tard, it has lost some of its gains. I'm still in the green on this position slightly. Alibaba, there's just a sector-wide fear in China, and the Russia-Ukraine conflict is definitely not helping either. They're going to be reporting earnings, I believe, tomorrow. So we'll see if that moves the stock or not. I wouldn't be surprised if it didn't, because this is not trading in line with its fundamentals and its earnings and its growth potential. It just has maximum fear priced into the price at the moment. So we'll see where this goes. Brookfield Asset Management has actually declined as well. So again, this is a newer position. I just bought it a month ago. I'm not taking the results too seriously because you don't know where your stocks are going to head, at least when you buy them initially. So down 5% here. Scotiabank is doing fantastic. Again, all the banks are. They're pulling back a little bit, but they're still near their all-time highs. Canadian Apartment REIT is also down about 4%. Again, newer position. So you never know what's going to happen when you buy a new position. It could go up a lot. It could go down a lot. The main thing is just if it goes down, you can buy more. If it goes up, well, great. You're a genius, self-proclaimed on the internet. All the income funds seem to be doing fine, but again, these are not positions we're trading. They're just giving us a lot of passive income in the portfolio, which is my main strategy. I bought another share of ETHY to bring us up to 39 shares. I bought 2 more shares of HYLD for more income from my American stocks. So this is actually paying over 10% yield right now, and it's monthly. And the new position that I picked up is a Loblaws. So with this one, I wanted something in the food sector, something in the consumer defensive, and I thought, what's better than food? People need to eat. Because we're in a economy with really, really high inflation, at least up here in Canada, I'm thinking, okay, how can I use this to my benefit? It's like, what's a business that benefits from inflation? I mean, unfortunately for you and me, and for anyone that, has to eat to continue living and existing, Loblaws is an essential business. If the price of something goes up, you have to pay it. You have to eat. There's really no choice on your part. And And I looked at their financials, and I think that it's a solid bet. Again, that's just my opinion. I'm not a financial expert, not financial advice, but I'll be going into why I picked Loblaws over the other large grocery stores in Canada. And again, just like Apple, Microsoft goes down as well. Smart Center's doing very well. Good real estate, POW's down slightly. Oil's doing fantastic, of course, because, if Russia goes to war, then there's less oil, and we need more oil in general. It's an underinvested sector. TELUS has just been an all-star. It's just like market crash. I don't care. I'm just going to go up a lot. So it's up over 13%. Same thing with TD Bank, up a lot. And Tesla, which is a growth stock that doesn't pay a dividend. Again, just like BABA, it's down. These kind of stocks are really out of favor right now. So you have to be really careful with the valuations you're paying, especially right now in this current market. And Loblaws owns about 35% of all the grocery stores in the Canadian market. I mean, you're going to notice a lot of these brands and a lot of these stores. So they even have their own store brand of, President's Choice, No Name, Farmer's Market. So these are essentially like, the generic version. But again, these are the store brands. So if you're familiar with Costco, you can kind of think of it like the Kirkland brand. So whenever you buy these brands, the store makes more money. You save money because you're not buying, you're not buying Tide. Maybe you're buying No Name detergent or whatever, or food. So it's a great way for them to increase their profit margins. It also helps the customer in times of inflation because people tend to forgo the fancy brands and go for the store brand to try to save money. So that benefits them even more in tough times. So yeah, they own Loblaw stores, Zehrs, Independent, Value Mart, Provigo, Superstore. They own Fortino's. They own T&T, which is like an Asian grocery store. No Frills. So you've probably seen or shop at multiple of these stores without even realizing it. And they also own many, many different pharmacies. So they own Shoppers Drug Mart. Pharmaprix is just what they call it in Quebec and other French-speaking provinces. Wellwise by Shoppers, Medical Cannabis. And again, they use the Life brand as well. So that's their store brand that they use to increase margins as well. And they even have a clothing line with Joe Fresh. So and these are mainly at the Superstore locations, at least from what I've seen. And they use PC Financial products. So again, they have a rewards membership, a loyalty program that keeps you shopping at their stores. And they also have a President's Choice, bank that you can use. It's like a free bank account, and you can earn points like that as well. So it's just an ecosystem that can keep you shopping exclusively at their store. So that's one kind of unique thing about them versus the other competitors up here in Canada. And then here's a little spreadsheet I made comparing all three companies together, the three major grocery giants of Canada. So we have Loblaws, market cap 32 billion, Metro 16, Empire 10. I looked at their balance sheets, calculated their assets over liabilities. It looks like Empire and Loblaws are both similar at 1.45. Metro looks like it has the strongest balance sheet out of the three at 1.9. So that's something to keep in mind. I've recorded their revenues, and I've calculated the free cash flows relative to those revenues. And Loblaws is just way more efficient at converting revenue to free cash flow at the end of the day, which just indicates to me, maybe they're a little bit more efficient and have a better run operation than Metro and Empire, because they're very similar. 4.78% of their revenues get turned into actual cash at the end of the day. Empire 4.42%. Loblaws just really stands at 7.4%. I even calculated the dividends paid. So Loblaws and the payout ratio relative to free cash flow. So Loblaws pays out 12% of their actual cash profits at the end of the day. So it leaves them a lot of room to raise dividends in the future for you, the shareholder, which is great. And it makes it safe, because, things happen. If the cash flow goes down, they can easily afford the dividend. It's not going to stress the company. They still have plenty of money to reinvest back into the business for future growth. Metro, not as hot with the payout ratio, 28%. So if they were to, it's still a safe dividend, but again, not as safe as Loblaws. Even Empire has 11.67. So then to put a value on these companies, I'm going to use price to free cash flow. So I'm taking their free cash flow and I'm seeing, how many years would it take to basically buy the whole company at the current valuation? So 32 billion. So Loblaws is trading at 8 times current free cash flows, which seems kind of okay. But let's compare it to Metro. Metro is trading at 18. So let's see here. Metro is less efficient at converting cash flow to revenue. Their payout ratio is more than double Loblaws, but they're trading at double Loblaws' price to free cash flow. Now you could say, oh, maybe Metro, it's a smaller company, it can grow double the size of Loblaws. I mean, maybe it can, maybe that's true, and maybe that would completely justify the price, but I looked at the growth of all the companies. They look very similar. They grow slow and steady. So just at a glance, this looks kind of expensive, or maybe it's just fully valued. There's not much value here. And if we compare it to Empire, and I think because their assets and liabilities are very similar at 1.45, but Empire is not as efficient at converting free cash flow to revenue, and their payout ratio is a little bit lower than Loblaws, so they can definitely increase that dividend. And the price to free cash flow of Empire is 12.38, so you could argue that Loblaws should be trading at the same price to free cash flow as Empire. They are so large, they can negotiate with large companies like PepsiCo over pricing. So there's another thing going on with Loblaws right now.
Shoppers at this Loblaws in North Vancouver aren't keen to pay more, even for chips.
With milk and everything else going up, people want to have reasonable priced junk food.
The grocery giant Loblaw is locked in a dispute over prices with Frito-Lay, the maker of Doritos, Cheetos, and Lay's chips.
Loblaws did not want to accept the price increase that Frito-Lay had put forth to them. And so you're starting to see the consequences of that with very empty aisles.
Loblaw's CFO talked about dealing with price hikes from vendors in a recent earnings conference call.
Our team uses a thorough process to vet pricing requests. We work hard to negotiate those increases down so that we offer our customers the best value.
Thank you for watching the video, and you can join my link for Wealthsimple down in the description below to get a free stock worth up to $4,500.